You ever look at one of those hot new tech companies? You know the ones, they're growing like a weed, everyone's talking about them, but they're not making a single dime in profit? And you just have to wonder, how on earth is this company worth billions of dollars? It's a classic problem in modern finance, but there's a specific tool analysts use to figure it out. Let's get into it.
This is the big question, right? For so many of these innovative, fast-growing companies, your standard financial toolkit, well, it's pretty much useless. Take the famous PE ratio, price to earnings. If you don't have any earnings, you can't have a PE ratio. So what do you do then?
Well, this brings us to what we call the profitability puzzle. When profits are zero or negative, those old-school valuation methods just fall apart. Investors need a completely different yardstick to figure out what a company might be worth.
And here's the tool they pull out of the toolbox: the enterprise value to sales ratio, or as you'll always hear it, the EV sales ratio. This is the go-to metric for making sense of companies that are all in on growth right now, even if it means profits are years away. It shifts our focus from the bottom line straight to the top line.
So to really understand this ratio, we have to start with the EV part, enterprise value. And the absolute best way to think about it is as the true takeover price for a company.
See, market cap just tells you what it would cost to buy all of a company's stock. But enterprise value, it gives you the real, all-in cost to buy the entire business, lock, stock, and barrel. It's the number an acquirer actually has to write a check for.
And how you calculate it is actually pretty intuitive. Think about it like you're buying a house. You start with the market cap. That's the sticker price on the house. Then you have to add all the debt, because if you buy the company, you also take on its mortgage, right? But then you get to subtract all the cash the company has on hand. That's kind of like finding a safe full of cash in the basement that's now yours. And what's left over is the true cost.
So let's just nail this down. Market cap is about the shares, the equity. Enterprise value is about the whole shebang, the equity, the debt, and the cash. And that's exactly why, in the world of mergers and acquisitions, nobody really cares about market cap. EV is king.
Okay, so we've got our enterprise value. We take that number, we divide it by the company's annual sales, and boom, we have our EV/sales ratio. But what does that number actually tell us? What do we do with it?
Well, it's pretty straightforward. A high ratio basically means the market is willing to pay a hefty premium for every single dollar of that company's sales. Usually, that's because investors are betting on some seriously explosive growth down the road. Now, on the flip side, a low ratio might mean you've stumbled upon a hidden gem, a real bargain, but it could also be a major red flag that there are some serious problems lurking under the hood.
But here's where this ratio really shines. It's not about looking at one number in isolation. It's about comparing. And when we look at a tale of two multiples, we see how the market values revenue in completely radically different ways.
And this right here is one of the most powerful concepts in all of finance. You have to understand this. A dollar of sales from company A is not automatically worth the same as a dollar of sales from company B. It's the business model behind that dollar that makes all the difference.
Okay, take a look at these numbers. This is incredible. We're seeing a huge range here. Up at the top, you've got design software companies trading at 5.5 times their expected revenue. But way down at the bottom, you see ad tech companies at just 1.1 times.
And this chart just makes that gap so obvious it practically screams at you. It is a five-fold difference. So that begs the question, why on earth would the market pay 5 times more for a dollar of revenue from a software company than from an ad tech company?
It all boils down to the quality of that revenue. I mean, think about it. Once an entire company of engineers is trained on, say, a specific design software, the cost and the headache of switching to a competitor is just massive. That creates a powerful competitive moat. But ad tech, they live and die by the whims of platforms like Google and Facebook. One little algorithm change, and their business can get crushed overnight. So the market rewards that sticky, predictable, locked-in revenue, and it punishes the fragile, risky kind.
So this ratio is obviously super powerful, but, and this is a really big but, it has one major critical weakness. To use it right, you have to be aware of its blind spot. And here it is. The EV/sales ratio completely ignores profitability. It tells you nothing about costs or efficiency. A company could be doubling its sales every year, looking like a rock star on this one metric, while burning through cash so fast it's just months away from going bankrupt. This ratio won't show you that.
You just have to remember what its job is. Its job is to measure the market's excitement about top-line growth. It's all about sales momentum, about the potential for future scale.
It answers the question, how fast is the engine revving?
Which is why smart analysts always pair it with another metric, EV to EBITDA. Now, this ratio looks at a company's actual operating profit. It asks a totally different but equally important question. Okay, but how efficiently is that engine actually running?
When you put them together, you get the full story. EV/sales gives you the growth narrative, the market's bet on what could be, and EV/EBITDA tells you about the operational reality of what is. You absolutely need both to make a smart call.
So let's wrap this all up. Now that we have this framework, we can look at those high-growth, no-profit companies with a much, much clearer view.
This is probably the best way to think about it. When you see a really high EV/sales ratio, you're not looking at a measurement of today's reality. What you're really looking at is the price the market is willing to pay for an option, a bet, that all of today's rapid sales growth will someday turn into huge profits.
And that leaves us with the million-dollar question, sometimes the billion-dollar question, that every investor has to answer. Does that high ratio signal a future industry giant in the making? Or is it just a sign of a giant, overpriced gamble? The ratio itself won't give you the answer, but it tells you exactly the right question to ask.